Hi everybody, Joe Conroy, certified financial planner, author of Decades in Decisions. I'm doing a video series where I talk about the book that I wrote on financial planning and get into just a couple of topics from each of the chapters, just to give you an idea of what's in there, and it might provide some value. So what I'm going to talk about today is one of the sections in your 40s, which is investing mistakes, what they are and how to avoid them. So as you can imagine, as a financial advisor, a lot of times I think people are afraid to come to meet with me or any financial advisor because you got to open up a little bit. There's some skeletons in the closet. You made a bad mistake. You bought something that didn't work out. You didn't buy something that did work out. But here's the thing. When you go to a personal trainer, you go there knowing you don't know all the different exercises, right? That's why you go to the personal trainer. And hopefully they don't make you feel dumb or lesser than because you're not in tune with all the new ways of working out and achieving your financial goals. Financial planning really should be no different. A good financial advisor will sit, will listen, not pass judgment. And quite frankly, how can we pass judgment? We've pretty much seen everything, right? So it's not often that I'm surprised these days when someone comes to me with something. A couple $100,000 in student debt, I've seen that plus some. Real estate investments that go completely sour and leave you in a big hole in your financial plan. I've seen that one. Business that doesn't work out. I don't have anything saved and I'm older, whatever. You name it. I've seen a lot of different mistakes. Let's talk about investing mistakes specifically, like in the 40s chapter. So chasing returns, right? There's always a shiny object in the financial world. Ooh, this has done really well over the last 12-month time frame, or it's over its 200-day moving average, or whatever the pundits on TV are saying. Once you see something that's gone up in value, it injects confidence in the novice investor, saying that that's going to continue forever, right? And when something has dropped, all of a sudden, ooh, I don't know why you'd want to buy that. That one isn't doing that well, right? If you look at the overall market, anytime that the markets drop, can't guarantee it in the future, you've always prospered by buying in at these lower prices for the eventual recovery if we're looking at broad indexes, right? So I'm not giving advice, I'm just saying that just because something has gone up doesn't mean it will forever. Just because something's gone down doesn't mean it's going to zero. So just try to separate the noise from profitable, actionable investing advice. One of the other investing mistakes that I write about in the book, and it's not a super flashy one, it won't win any awards, but it just tends to be a very favorable strategy over long periods of time for a lot of investors, if not all. Don't be overly concentrated, right? Investing in your company stock at work, who provides your paycheck, your benefits, and has a 401k that's also invested in the stock and stock options on top of that, and yada, yada, yada. You're very concentrated. So I'm not saying that diversify out of Amazon back in 2000, right? But just know what the downside is. And if you're not sure what the worst case scenario might be, have somebody to help work that angle for you. And you can mitigate those risks, right? So make sure that you aren't overloaded into one sector or one company, that you have a couple of eggs at least in a few different baskets, so that if one thing or another doesn't work out, you're covered. It's a tale as old as time, but what I can tell you as a financial advisor, and I'm sure you're sitting there shaking your head, Joe, I already know this stuff. Yeah, but you would be surprised how often people come into the office and they don't have the diversification they thought. Example. So somebody that I recently met with had 3 different 401k plans at previous employers. So they're like, well, I'm diversified. I got 3 different 401k plans. Inside those 401k plans, it was all one specific type of stock. Tech, right? Large growth and technology. Well, there's a few other places. That's been a good place to invest, but they thought they were diversified. I got 3 different things doing 3 different things. They had 3 different of the same things, right? They thought they had chocolate, strawberry, vanilla, ice cream when they had strawberry, 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 right? Now, whether they do anything with that advice or that realization that they're not as diversified, different story, but at least you want to be informed with what you have and know the potential pitfalls so you can make more informed decisions, which usually lead to better decisions. So anyway, more investment mistakes are listed in the 40s chapter. Those were just a couple. Stay tuned for more sections from the book. And as always, thank you for watching.